The RSI is a very useful and powerful tool indicator to use when trading, regardless of whether it's stock, currencies, etc. And it lets investors know when a trend might be coming to an end and reversing, whether up or down. Welcome back to Investor Prime. If you're new to the channel, make sure you subscribe. Follow me on my social at Investor Prime. Alright, let's get into today's video. Alright, in today's video, I'm going to be discussing the RSI. So the topics I'll be discussing are: what is the Relative Strength Index or RSI, the origins of the RSI, conventional ways to use the RSI, and high success strategies with only the RSI, if that's the only indicator you're going to be using. So how you can get high probability setups using only the RSI. So what is the RSI? So the RSI, Relative Strength Index, is a momentum indicator. So this basically is as the price fluctuates, so moves up or down, this calculates the momentum, this indicates how much movement the price is seeing. It was developed in 1978 by J. Wells Wilder. So basically this was to help investors at the time and now understand what's going on in the market and try to see where the trend may be coming to an end. It may be losing steam and possibly reversing, whether that reversal is temporary in what's called a dip, or if it's a full-on reversal, like straight down, you know. The RSI is made up by the following calculation. RSI equals 100 minus 100 over 1 plus the average gain divided by the average loss. So this calculation may look complicated, but in essence, what it's trying to tell you, or what it is telling you, is that if the average gain is greater than the average loss, then the momentum is towards the upside. That means the bulls have taken control of the market and the price will continue to rise. So conversely, if the average gain is less than the average loss, this means that the momentum is towards the downside. Hence, the bears or the sellers have taken control over the market and the price will continue to fall. So this is in the form of, however, the conventional way to use the RSI is to focus on two key values. So that's the 70 and 30. If the value of the RSI is above 70, this means that the price of the security is overbought, which gives you confidence that at some point the market is going to reverse and start coming down. Maybe the buyers would have lost steam and the sellers will kick in and start driving the price down. Conversely, if the value of the RSI is below 30, this means that the sellers, or it gives great confidence that the sellers are generally losing steam and the buyers at some point will kick in and drive the price up. The RSI is a very powerful and very good tool to use for understanding what's going on in the market. However, it's not very good in a strong trending market, and I'll highlight these through the charts and explain why. It's generally best used when the market is in a sideways movement. Alright, so let's go into the chart. Alright, so here's a chart of the Bitcoin US dollar cryptocurrency market. So basically, we're in TradingView, which is a charting platform. To get the RSI, all you have to do is go to the FX, which are your indicators and strategies. And then once you go here, there's a huge list of all the indicators, but right now we're only interested in the RSI. So you go to the RSI Relative Strength Index, and then it'll plot it. I've already plotted an RSI, so it's doubled it up. So I'll just go ahead and delete one. Now we're in the RSI. So the dotted lines indicate the conventional values, or the values to focus on with the RSI, which are 70 and 30. When the RSI exceeds 70, you can generally see that the market is overbought and sellers would start to kick in, or the buyers are losing steam. One of the things that make the RSI very good is in a way, it's a self-fulfilling prophecy in the sense that if everyone is looking at the same data and everyone's thinking of the same thing, like for instance, if everyone's looking at the RSI and saying, okay, when the value is over 70, it's overbought. So a lot of people who are long would, or buying in the market, would start to ease off their positions, would start to close the positions, or maybe reduce the positions, or maybe go to the opposite end and start selling because they believe the market's going to start retracing back down, and hence sellers start kicking in, and everybody who is placing sell orders, etc., in the market, or increasing their sell positions in the market, would generally start to drive the price down. And that's why it's seen as the buyers are losing steam, because everyone's looking at the same data. And conversely, if the value is below 30, a lot of sellers would start to ease off the positions, close the positions, and then it makes more room for buyers to get in, and the demand kicks in and overwhelms the supply, which drives the price up. Okay, so as you can see here, the value of the RSI is above 70. So sellers start to try to kick in, but the trend is too strong with this. So it continues pushing up. A lot of buyers, in this case, a lot of people who maybe believe that the price is going to continue rising, they stay in the position. Also, a lot of people who are maybe greed kicks in. They start to say, oh, look, I'm making a lot of money. Let me just hold in. Let me just hold in. It'll continue going to infinite. So this creates a strong trend. But as you can see from at the price of 12,116, a huge amount of sellers kick in and try to drive the price down. But the buyers are holding on and keeps the value of the RSI above 70. And eventually it cracks, the buyers give up, and the sellers kick in and then drive the RSI back down towards 30. Let me just remove this. So I'll show you a good example of where this would work. In my opinion, the RSI works better on stocks, basically, in the stock market, rather than currency markets or Forex and like cryptocurrencies. So let's go into a stock. Here's a stock that everyone knows about, Tesla, and I've put the RSI against it. So just gonna try and analyze. And as you can see, in a very strong trending market, the RSI is, I would say, in my opinion, is practically useless. It's only good when the market's in a sideways pattern. However, even in a strong trending market, there's ways you can use the RSI that will increase your probability and give you a high success rate if you follow it. If you have a disciplined approach towards it, but I'll talk about that in a moment. So first of all, let's see where in this case the RSI has worked where it's not a strong trending market. So as you can see, the RSI has been dropping and then goes below 30, which means that the sellers are losing steam and the buyers at some point will kick in. Now the RSI is good at telling you where the price is going to be and where you can, to a high degree, predict that the market is going to turn, but it doesn't tell you when exactly the market is going to turn, which is one of the cons of using the RSI indicator. So you just have to be patient, align your strategy so that you can give yourself enough room to allow the market to do what it's doing and then turn. So this is a good example where the market goes below 30, the price of Tesla goes below 30, but it continues going down because there's a lot of sellers still in the market. Although buyers are kicking in, there's not enough buyers to overwhelm the sellers, so the price continues to fall. There's a lot more supply than there is demand at this point. So it continues falling till it gets into the 30 zone around $40 a share and continues to fall down to around $35. So effectively falls an extra 5 before the buyers kick in and overwhelm the sellers, and then the price starts rising. So that's what I'm saying with, you need to give yourself enough time. Like when you're setting your stop loss, make sure you're giving yourself enough room to allow for this move, so you don't have to be lowering your stop loss or adjusting it in any way, which is a very big mistake when trading. So the RSI kicks in and the buyers kick in and take over, and then the price rises from here up to $52, which in fact I would say up to about $50, which is where the RSI value goes above 70. So at this point you can expect that the price is going to reverse and start coming down, because you believe the bulls or the buyers are going to start losing steam, and then the sellers are going to kick in. And that's exactly what happens here. Although it goes up a couple more, for $3 more to 53, and then the market on the open of 25th of July 2019, it kicks in. The market open of 25th of July 2019 gaps down, and then the sellers start coming in. It tries to go up but continues to fall. I'll look at another market. Let's look at a Forex market. So Euro US dollar, which is a currency pair that everyone knows and is widely traded. So here's a good example where the RSI would have worked very well. So the RSI of the Euro US dollar comes down, continues to fall. So it goes below 30 at this point. So at this point, it continues to fall. It's still a bearish trending market at this point. So the price continues to fall. And eventually the bulls kick in. Eventually a base is formed, which forms a good support zone and support line at 107.804, and the bulls take full control of the market and drive the price right up at this point, all the way up to 114, etc. So about 1,000 pips. So the bulls drive the market up to about 1,000 pips, and which coincidentally you see it edges above 70, but it dips down. So that wouldn't have been good. You need to give it some time to either be in 70 to increase your probability of success, or below 30 to increase your probability of success of a reverse. It won't be wise to, the minute it just touches 70 or 30 or below, to go straight into the trade. It's a very aggressive way to trade, and if your strategy, your emotions, everything allow you to do such a thing, then by all means be my guest. But me, I'm more conventional with my trading. I like to wait for a confirmation, wait to see that the market is telling me that, look, this is what's going on. What are you going to do? So that's why at this point, I wouldn't have done anything. I would have kept watching the market. If it dipped down and continued falling, that's fine. I would have missed an opportunity. I would rather miss an opportunity than to get in at the wrong time and lose money. So I would have waited. So it's still above 70 and it stayed above 70. So I would have been like, okay, that's fine. Now I can pull a trigger. As you can see, this wick, this shows some resistance in the candle. As you can see, sellers are kicking in. So I would say, okay, it's the RSI is above 70. There's some signs of resistance happening. So I would be more confident to take a trade. If I wanted to take a trade on this bullish candle, despite it still being in an uptrend, and lo and behold, the price falls, basically the sellers take control and drive the price right down to nearly 30, and then it keeps going then it goes into a sideways market. It tries to rally up, but the sales come down. So at this point, there's really a battle between buyers and sellers until the buyers take control over here, and then the price continues to rise. Okay, so that's with using a Forex market. And again, here, as you can see, the price more recently, the price is above 70 and it's staying above 70 at this point. You can see that the sellers are trying to bring the price down, and effectively is creating a resistance zone. So I'll draw the lines to show you the resistance zone. So it's around here when it pretty much the first resistance kicks in, and here is your support. So it's trying to, there's two ways this market can play out in a sideways market. So it can either, when it creates a sideways market, it can either keep going until it breaks the resistance and continues going up, which can be seen as a breakout strategy, or it can break the resistance, the supports, or it can break the support and continue falling, which is a breakdown strategy. So as you can see here, for another day, but just highlighting. So this is just a channel showing it's bouncing between the support and the resistance. The market's uncertain where it's going, so that's a sideways market. And as you can see here, it's broken that, and it's heading towards the 30 zone. So you see when the RSI reaches 30, then it should start climbing again. Okay, now that's the conventional way to use an RSI. So basically when it's above 70, you place your sales, or you look to be bearish, and when it goes below 30, you look to be bullish because the market is oversold, and when it's 70, it's overbought. Alright guys, if you enjoyed that video, make sure you subscribe, like, comment. Let me know what your thoughts on the RSI are, how you use the RSI, get a discussion going. You'll be helping yourself, others may even be helping myself. Make sure you subscribe. I'll get a lot more videos out on more indicators, etc., and how I use them personally, and how I believe they could be used effectively. Again,